Welcome to The Mortgage Life, a space for down-to-earth conversations about how mortgages contribute to your life.
Well, that sounds canned and maybe a little boring.
What? There are so many parts to the mortgage industry and real estate finance we can explore and share with our listeners.
Okay, you're right. You're right, Mindy. Our goal is to help secure our clients' financial future.
I'm Pete Solomosi.
I'm Mindy Bodwin.
And I'm Sue Solomosi. We're your hosts. Welcome to The Mortgage Life.
So, anybody else's house look like a piñata was broken and there's candy everywhere?
You're not allowed to look on my desk. There might be wrappers.
Yeah, it's
I get rid of my evidence, Pete. What are you doing, leaving wrappers around?
I'm horrible.
My kids had to come home in the middle of trick-or-treating to empty their bags because they were full, and then went back out and filled again. So it's a little bit overwhelming.
Well, you know, there's always a penalty to eating too much chocolate, which is that you get into a sugar coma. But speaking of penalties, you know, there's penalties when it comes to mortgages.
And just like avoiding a sugar coma, there are ways to avoid those penalties.
That's right. So we've found that some of the questions lately have come to, how do I access additional equity or move my mortgage or do things without actually paying a penalty? And thankfully, there are ways to do that. So that's what we're going to talk about today. So why don't we start today with doing something at the maturity date? So like if you've got a 5-year term and it matures on November 1st, then on November 1st, it's a very special day.
A very special day. You could celebrate the day. But before we dive into, we've got a number of different ways to access equity without incurring that penalty. We want to make sure that we're looking at the broader market conditions, the situation of the individual client, because just like with any file, if we're looking at pulling out equity and wanting to avoid that penalty, we need to figure out what's best for that client and what's going to be best for them in the long run. So your maturity date is so special because that date in Canada is the day that you can do whatever you want with your mortgage with no penalty.
Yay.
You could send it on a vacation. You could dress it up for Halloween to send it trick-or-treating.
It could eat a lot of candies.
It could eat a lot of candies, depending on the size of your mortgage. But if you want to change your mortgage on the maturity date, you can do that.
Right.
And that's whether you go to a new lender or stay with the same lender.
So that's the big pro on the maturity date is that you avoid that prepayment penalty. And that can be a big number. So it's not just simply, a few $100s. We've actually seen prepayment penalties in the tens of thousands of dollars. So it can be very significant.
$80,000 was the largest prepayment penalty I've seen.
Exactly.
Mm-hmm.
So that eats into your equity. So if you can avoid that, then hey, this is a big pro.
So you can change your mortgage amount. So if you want to pull out extra money, if you want to put down a lump sum, I've got some clients that are waiting for their maturity date so they can put down a larger lump sum than the pre-penalty allowance, right? Like prepayment privilege.
Yeah.
PPP. Yes.
15 to 20% of your original mortgage balance. That's standard. But if you want to pay more than that, you could do it on your maturity date with no penalty.
Right.
So this sounds like a pretty great time to make changes, but there's got to be some cons to this.
So the cons are, I guess if we can call them cons, they're kind of typical mortgage charges. So things like a legal fee to register the mortgage transaction, potentially an appraisal, potentially new title insurance. These are all things that have to happen when you do a new mortgage. So those things are potential cons.
Yes. And you're pouring sugar on it. All that was going it was a song in my head, pour some sugar on it. It's going to cost money. To redo your mortgage. There are legal fees, and all of these fees typically come in around a couple $1,000s, depending on the mortgage charge and what you want to do with it.
And that's if you are making changes. Obviously, if you're just moving from lender A to lender B, which is called a switch, just for a better interest rate, then quite often there aren't as many fees involved. The big con for me, especially in a high interest rate environment, is that you have to wait till the end of the term to do these changes.
Right.
What if I don't want to wait that long? Are there other options?
You sound like a millennial, Mindy.
I'm
I don't want to wait.
whining. I'm channeling my sugar high children at 8 p.m. last night.
Right. So if you're in the middle of your term, and let's say it's a scenario just like we have today, you might have got your mortgage 2 years ago when interest rates were so crazy low. What you can do is you can actually port your mortgage. So if you want to sell your house and move to a different one, you could move your mortgage from the current house that you're selling to the new one that you're buying.
And to be clear, you can do this at any point in your mortgage. This does not have to happen on the maturity date. So we're
Right.
on the next kind of option for
Yes.
accessing equity or utilizing your mortgage without incurring a penalty, picking up your mortgage and taking it with you.
Yeah, and this has been very common this year if we're looking at, renewing into a rate in the 5s or 6s and your existing is in the 2s or 3s. It's really awesome to be able to take that mortgage with you to the next house.
Mm-hmm. But when that happens, you do have to go through the same qualification process. So if your situation has changed since you first got that mortgage, then if it hasn't changed, great. But we do need to still reconfirm all your employment details, property taxes, all the numbers that go into your mortgage application.
Yeah. And in mortgage broker speak, we still have to qualify and debt service. All right. I've got the
Okay.
terminology out of the way. Technology.
The pro for this one is avoiding that prepayment penalty, keeping that interest rate the same, not changing your mortgage at all, but except moving it to a new property. The cons, again, on this one are the fees. So there are legal fees, and there's usually a port fee from the lender. They'll charge a few $100s for the administration of that change.
The other important thing to remember on a port is you don't have a change in that mortgage amount. You're picking up that mortgage, like you said, Sue, and you're moving it to the new place. So if there's any difference in the purchase price of the new place to the selling price of your current place, then that may either have to be made up with cash that you have on hand or some other resources that you have to pay the difference. So this thing stays the same.
And conversely, if the new house you're buying is less expensive than the one that you're selling and you need to pay off some of that mortgage that you're porting, then there will be a prepayment penalty on that mortgage portion that you're paying off.
Over
Right.
and above the privilege amount. Yeah.
Mhm.
That's right.
But what you're referring to, Pete, is a port increase, right? If you're purchasing a house that's more expensive and you don't have the extra cash on hand to make up the difference in the purchase price, you can still add. Typically, a lender will allow you to add to your mortgage. So you're going to keep your current mortgage at your current interest rate, and then you're going to add to your mortgage. The new money that you add on is going to be at current interest rates. So you're going to end up with a new mortgage essentially at a blended interest rate.
Right. So options if things do change.
Yep. And not necessarily any penalty. We're talking about things that you can do that do not incur a penalty, or maybe not that definitive, may not, because there's always some sneaky things that happen. So this is why you always need to talk to your mortgage broker or your mortgage professional for advice.
But that's definitely a big pro, that you get to keep your existing mortgage rate, and that you can add to it.
Mm-hmm. So what if you're not porting your mortgage? If you're not moving your mortgage, but you still want to pull out a little bit of equity without touching your first mortgage, the next point we have here is a top up. So essentially doing the same thing, pulling out a little bit of equity at the new interest rate and ending up with a blended interest rate on the final version of your mortgage.
So again, the mortgage would be a blended mortgage, the blended rate, previous rate plus new rate. Advantageous in a market such as this, where again, we were seeing increasing in interest rates. But if it's the opposite, so say we're now looking 3 years down the road and maybe interest rates are lower, this idea of porting or topping up your existing mortgage might not be as advantageous based on market interest rates. And this kind of refers back to that point that Sue made at the beginning, which is that in all of these cases, we're always looking at what works best for our clients in the broader market conditions.
And so if you want an example, I mean, I've done all of these things this year for clients because we do have a lot of mortgages in place right now that are carrying very low interest rates. So I had a client who wanted to purchase a cabin and had enough equity between her owner occupied and the rental properties in her portfolio. We were able to access enough equity, penalty free that you could purchase this cabin property outright without having to worry about financing on the cabin portion. Really cool that we have access to lenders that do allow us to be that creative, give us that amount of flexibility within existing mortgage terms.
And keep the clients out of the penalty box.
Right.
And avoid an unconventional, potentially expensive mortgage for a cabin, right? That's a really unique property type.
Yeah, It was like leased land. There was a whole lot of layers that we would have had to go through in order to get financing on that. So for sure, it was a win for sure. The cons also in this situation is the fees. Again, right? There's going to be appraisals, especially in this market with real estate value or market values being so dynamic and changing almost by the day. So more often than not, we will need appraisals, legal fees. We don't ever try to do this stuff without talking to a lawyer.
So there's one other option if a person is looking to retain their existing mortgage and not have it pay out, so that triggers a penalty. And that is by putting on a second mortgage. So oftentimes we talk about kind of just the standard mortgage, which is usually, and we haven't really mentioned this in the past, but that's typically a first mortgage charge. We can put a second mortgage charge on, and that would retain your existing first. So maybe Sue, I think you've done a few of these, and Mindy has done too. Tell us a little bit about how that second mortgage works and pros and cons.
When I first started in the mortgage industry, second mortgages only came from private lenders. Because they're a second mortgage charge, is a whole different risk, right? They're not in first place on that title. So when you look at the title, if something happens and the lenders on the title need to get paid out, the first person listed is going to get paid first. And you just hope there's enough equity to pay the second as well. So it's a higher risk to be in second position. Recently, we've had a couple of prime lenders come on board with a second mortgage program to allow us to do exactly what we're talking about today, to allow clients to access equity without getting stuck in that penalty box.
In my mind, risk in the mortgage industry translates to interest rate for the borrowers, right? So when we're talking about a lender taking on a higher risk lending scenario, they're usually going to compensate that with a higher interest rate. So when we're contrasting, why can't I, what's the difference between doing a top up to a mortgage versus getting a second mortgage? Quite often, the second mortgage does have higher interest rates.
It does. And the interest rates aren't too bad. They're usually, I've seen them as a variable rate, prime plus 1%, something like that. Open term, 1-year term, renewable with the existing mortgage. It was a good point though, Mindy, like why would we get into a second mortgage versus topping up and doing a blended rate and taking advantage of finding your equity that way? The second mortgage allows a borrower to access the equity without touching that first mortgage at all. So with the blended rate, they are actually paying out the first mortgage and blending those interest rates together. This is like a behind the scenes. What am I looking for? What they're doing the work behind the scenes. On the second mortgage, your first mortgage doesn't get touched. So if your first mortgage was insured to start, so if you started with CMHC, SAGEN, Canada Guarantee, if you've got insurance on that mortgage, we want to keep it there to give you, because that is an added level of protection for the lender, for yourself as a borrower. So we don't want to touch that first mortgage. That's when we would use a second mortgage to access equity.
And that first mortgage being insured, also on renewal, you can access insured rates as well if you don't make any of these changes, if it still stays the same.
And insurable rates are lower than uninsured rates. So that's why we typically want to keep those in place.
Yeah, I feel like we are getting into the weeds a little bit here. That's
very weedy.
Some really fine points. I think at the end of the day, the purpose of this episode is to let clients know that there is opportunity. There are options to access your equity without necessarily having to pay that penalty.
So if you're in a scenario where you are looking to tap into equity, or there is movement from your current house to a new house, don't necessarily go with the first thought, which is that we have to pay out the mortgage. Because if you've got a good rate, it may very well be worth trying to save that rate and riding it out for the remainder of its term. But contact your broker to find out how it's possible and at least game out the various scenarios.
This is The Mortgage Life.
We look forward to continuing the conversation.
So come back and listen.